Are you going to sell it same day? Are you going to sell it end of the day? What are you going to, so like the thing is that like once we start looking at trading in terms of it being an investment, that means like each and every trade that you are taking, if you consider it as you investing your money into something so that it can yield results, now that becomes a whole different thing, becomes a whole different approach, because now you understand that like the market obviously fluctuates, right? The market moves in the form of waves. So if the market does move in the form of waves, that means that like even if there is a retracement, if you are confident in your position, then let it do whatever it needs to do, right? There's no need for you to get in today, tomorrow get out, get in and get out by the end of the day. That's just my opinion, right? And then one of the things that I have discovered is that like there are so many materials, there are so many books that have been written, right? And these books are written based on day trading, and they are written based on scalping. Though this is good, the fact that we have forex literature, but again this is a double-edged sword, because the forex literature itself, it can be harmful. So let's say for example you get in and then you get out, right? So when you get in and get out, now that becomes a habit, right? You are in a habit of getting in and out of position. So that means that like each and every day as a day trader, you're going to look for possible positions. You're going to look for ways in which you can enter into this situation, enter into a trade, do something, because like that is your addiction. You are addicted to getting in and out of trades, right? Okay, so day trading, it's not as harmful as scalping, right? Scalping, it's seconds, 5 minutes, and all those things, they are very harmful to traders, right? So but like the thing is that like people will never speak about them, and those people that are advocating for them, in most cases they are still under their mother's house, or there is an alternative source of income. But if you want to make trading your source of income, my suggestion is that swing trading and position trading. So swing trading and position trading does not mean that you enter a position and just relax. No, swing trading, what it does, in position trading, what it does is that it gives you an opportunity for you to hedge against your already existing positions, and to also scale in against your already existing positions. So now someone will ask, hey, what do you mean by that scenario, right? So for example, let's look at this situation, right? So now let's say that you have short positions that were located somewhere around here. I just want to show you something. So the short positions that you have that were located somewhere around here, now they are at break even, obviously, because you had a strong push to the downside, right? So now you had that reduction in price. Now let's say that you obviously upon taking those short positions, now the market reduced in value. The minute you start spotting possible retracement, this is when you hedge. And the hedge positions, basically what you do is that you hedge against your already existing position. Then the price, now when you hedged, obviously the price when it pushes up, what you do, you break even on your positions, right? So now look at the beauty of this. The beauty of this is that like now you already have positions there, right? You're already hedged against your already existing buy positions somewhere around there. So now you've got two positions within the market, with the other one is a sell, the other one is a buy. This is called hedging. You hedge against your already existing sell positions. Upon hedging against your already existing sell positions, now you've got a buy position. Here is your buy position. What do you do when you get the buy position? What you're going to do is that now you're going to perform two parts. There are two things you're going to perform. You're going to perform hedging and scaling in. You get it? That's the beauty. The beauty of this. So the beauty of this is that like once the price drops in value, pushes to the upside, this one itself, now you already hedged against it. So now I have a bullish movement. This is no longer the things to worry about. Now worry about this one. The price pushed to the upside. Upon pushing to the upside, you're going to hedge against the buy positions that you already have, right? So you already have two positions now. You're adding the third one, which is a hedge. And the hedge is not just only a hedge, mind you. This is a hedge that is in conjunction or in combination with the scaling in. Now, let's say maybe you entered here at 0.01, right? Your hedge positions, obviously, keep the hedge position with the same, if not half. But unfortunately, you have to use the same. Let's say maybe, let's just thing. Let's say that you used 0.50 here. Let's say you used 0.50. Let's say you used 0.50 on your short positions. So your hedge positions are going to be 0.25, right? So you've got 0.25, you've got 0.50. The reduction in obviously this one reduced in profit. So here you make less as compared to the movement. So as the market retraces, you make half of the money that was made throughout this movement. Even if it gets here, you made half of the money that you run, right? So okay, let's say maybe you get to that position. So now when the price gets to this level here, you have profits from here and you also have partial profit from there. The combination of the two profits should give you at least a break even, meaning that now you can actually increase your lot size to 1, a standard lot, right? You increase your lot size to 1. So now you hedge against this move in combination with the profits that you have made from this movement. Obviously, you're already in break even. Now your stop losses can be located at roughly the same price level as the take. You can actually say that the take profit, but if you want to be safe, you can actually risk this profit without having the take profit of this one. So you just risk only the profit made from this initial trade that you executed. So now you are there, right? So now when the market drops in value, the distance that is going to travel, you're going to make twice the amount of money that you have made with this initial movement, right? And then again, you already hedged against this one. So the basis of hedging, what it does is that, like, hedge positions, you do not close them automatically. Hedge positions are supposed to be closed on your behalf by the market, not you. You have no business entering into, let me close. You don't close manually. The main objective of this being a hedge, meaning that, like, you have stop losses located somewhere around there. So now when the market pushes to the downside, obviously you left some food on the table. There was going to be a reduction in the profit that you made. It's okay. You must always leave some crumbs on the table, right? So now when the price pushes to the downside, this is accumulating profit. This now is regaining its initial profit. This one now, once it gets stopped out, then you already secured the profit. So now you're just going to look for the market to continue to drop in value, continue to drop in value, continue to drop in value, right? So this is the foundation of swing trading. Now it's moving towards position trading. So the combination of those things, they yield results, right? So now this is basically on a monthly time frame. When you go on a weekly time frame, what it does is that it's going to give you opportunities to scale in on your already existing buy position. This is a buy position. You scale in, you scale in, you scale in, you scale in. Find that you accumulated a lot of positions as price continues to push to the upside. Even here, find that you accumulated orders as price continues to push to the downside. This is just an example to show you, but I used only 1 and 2 positions, but you can add multiple positions if the price continues to reduce in value, right? That was not deep, ne? That was like very simple, ne? That's trading. It's very nice. It's lovely. I love this thing, guys. It's just like when I'm with this, man, you know, I forget about a lot of things, man. I forget about a lot of things. I don't have stress. I don't have, you know, but you just forget about a lot of things. Kind of like meditation, you know. So now, when you're on a weekly time frame, obviously you had a lot of things. That's why I say that, like, man, some things are very nice. They're very cute. So, but I just showed you something. I hope you guys learned something from it. I hope so. Oh, by the way, I did warn you about this scenario, right? So the thing about me is that, like, I won, guys. I won. You know, I'm taken lightly, but I won, guys. Like I said, I told you, the minute you start doing this and that, that's the minute your brain goes into blank mode. I told you, there is no bearish, there is no what the channels, the what, that is your brain seeing things. You're hitting it. But again, but get trip, you're tripping, you know. So you're going to have a trip, out of body experience, you're tripping. Because like now, the minute we start telling, like now for me, I'm going to try and show you other things and say, like, guys, you know, some of the things are not really that much of importance. And you guys think that I'm thinking that I'm better than you. No, like, it's you who thinks that I'm better than you. I don't think that I'm better than you. But the fact that you think that I'm better than you, it kind of like justifies the whole thing, right? But for me, I'm just here to tell you guys, this is my findings. So picture like, the problem is that you're so conditioned, you're so indoctrinated in the approach of technical tools that you even fail to take time and step back and you say, you know what, why am I using technical tools? Why am I depending on them? Remember, guys, I'm going to tell you something that is I've told you before. This itself, you see this thing that I've drawn here, this, it's called a linear tool. It depends, it's, you know, linear, that means there's calculations, there's what, a linear tool, right? Linear, right? Question, is the market linear? Is trading linear? Right now, that's a very simple thing. We are using linear tools in order for us to try to solve a non-linear problem. That's something that's going, it will never work. There is no way that you can use linear tools in order for you to solve non-linear problems. Go to the mathematic books and open the mathematic books. You've got linear, you've got non-linear. They are separated. The two are separated because, guys, come on. And I did explain it to you in terms of like linearity. Where was it derived? Linearity. All these things, they stem from philosophy. These are philosophical approaches. And there were two people that were present. There are two people that were present, right? You guys know them, ne? Galileo and who's the other one? I forgot him. Galileo and I forgot who is that. So it was Galileo. Right now, the linearity stuff, these are Galileo. Like everything that you see within the world, these are Galileo's. They stem from Galileo, the first man. Not necessarily the first man, but the physics comes from Galileo. They come from there, upper. You know? But like our forefathers chose to go with Galileo. But now my question is that, what if they chose to go with someone else? How would that have been? You know the saying that you can't step into the same river twice. You know the saying, you can't step into the same river twice, because now the river itself has changed and you are no longer the same person. You know who was the philosopher, the Greek philosopher? Heraclitus. Heraclitus a ke tsebe hey tla ba ka feletsa ke boletse dilo tse dingwe ya wa Heraclitus ana kwa le ke a kwa re ya Samuel mo ile ra ke rata mare ba re keng Heraclitus or mamang la ba tseba batho ba kgale ba gale ba. So these are two people, bro. You had two people right now. I'm schooling you guys. You know, you had two people. One was Heraclius, one was Galileo, right? The world, or our forefathers, chose to follow Galileo. That's why we've got physics, we've got all these things. But the question is that, like, who is this guy here? Who is Heraclius? This guy said that you cannot step into the same river twice, because neither are you the same person, and the river itself, it's no longer the same, because there's a flow. You understand? This basically this is the same principle that can be applied in terms of trading. That means that you cannot use the same tools in order for you to decipher the market back to back. It does not make sense, because neither the conditions of the market are the same. Even you as a trader, you're no longer the same person. So now that shows you the non-linearity of trading itself. But this is too advanced, guys. I know you're not ready about that. But again, let me just do it in simpler terms. The trend line didn't work. That's as simple as I can get to it. The third retest didn't work. I think this is something that the adjustments are already lined up, and they're going to adjust until they have something like this, and then they say there's a broad channel. But either or. Some people are, it depends, guys, you know. But my main approach to everything is to try to enlighten based on my findings. I'm not trying to make myself different or everything, but it's just that like the puzzle itself cannot be viewed as the same by everyone. Someone must view the puzzle a bit different. Not supposed to be all alike. We can't all be like upon the third. We can't do that, guys. But like, hey, I was just checking up on you guys. I'm not fighting, man. Either way, man. Either way, let's start again. Se se ke bophelo bana besho. Hey, se se ke bophelo. Se se ke bophelo. But again, do not define a consolidation based on how you perceive it, how you want to perceive it to be. Like, see it as it is. But other than that, guys, I hope you guys have a lovely is it Wednesday already? Yeah, a lovely week ahead. You know, this is the beginning of the year. It's going to be a very lovely year. You know, I can't wait to see what this year has in store for us. But I hope we're going to enjoy it, right? Let's enjoy this year, and then let's continue pushing. Let's continue putting in more work. It's called evolution, man. As a trader, it's called evolution. The evolution of a trader. A trader is supposed to evolve. You see the same trader speaking about the same thing, same approach, same. It shows that there's a lack of evolution, right? And the only way to evolve is to go and seek evolution. The unfortunate part is that the evolution is hidden between the pages of great books. But traders are allergic to literature. But don't worry, I'll vaccinate you. Hey guys, enjoy the rest of your day, guys. I hope you guys have a lovely day, man. You know, thank you guys for tuning in this year as well. Let's continue putting in more work, guys, you know, and let's be kind to one another. You don't have to be a real, like, you don't have to be a douchebag, you know. And you know, this year, honesty, integrity, you know, we move different. The vibe is different. We move with honesty, you know, pure hearts, pure intentions, nothing else, you know. Ka mangolo a makgetho ba reng, mangolo a makgetho are the ways of men are pure in his own eyes, but is the Lord who sees the heart. Ikwa mangwalo a makgethwa, meaning ditiro tsa hao di ka no hlweka mo mahlong a hao, mara mo pela sefahleho sa modimo ditiro tsa hao di bonala ka rapelo ya gago. Re bona botle ba pelo, language, meaning like inside, the inside matters more than